Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for January 25th, 2014. Market has moved back into bullish normal conditions. On an annual basis, using weekly RSI 14, we're back into neutral at a score of 59 out of 100. On a 10-day short-term basis, using the 10-day NDX, we're in oversold conditions with a score of 1 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is now red bullish at 5.94%. So we're still above the 200, still out of sideways conditions, but we're only 4% cushion. And the sell value as red means that it's more than one standard deviation below the 6-month average. And so this is a market at risk. Slope of the 50-day moving average pulled back to yellow neutral at 0.33%. ADX, the measure of strength of trend, increased to 15.5 and bears are in charge. ATR percentage increased to 0.93%. The risk index, excuse me, risk index is the 30-period moving average of the VIX divided by the 10. The demarcation line is 1.0. 1.0 or below, and we're in risk off conditions like we are right now, which says that riskier assets are not favored for holding. If we take that score of 1.0 and then compare that to the last 5,000 trading days, that gives us a z-score of minus 0.12. You can see on the 90-day histogram here the last 90 days of the reading on that indicator. We just tipped into the negative side, suggesting a swing and volatility is available for trading. Looking at blended monthly rebalancing, next reevaluation is due on or about 1 February. We're currently holding these positions in these different ETF portfolios. The current readings on these symbols you'll see here under the current leaders. It's still technology in US across the board. Inside ETF2, the theoretical exposure is reduced to 50%, with half the regions of the world market model on a cash position. The portfolio itself is 100% exposed with stops in place. There have been a number of pretty good videos, I think, uploaded at YouTube this past week. So if you look at youtube.com/Kennifer8, you can see those. Looking at the ETF 32 portfolio, about half are on cash positions, still dominated by the US. And really the same situation with the 32 ETF portfolio, excuse me. 2/3 are on a cash position now, with really only the US looking favorable. Looking at ETF Max, this is the top 50 out of about 1,300 ETFs. The ones that are white on 3-month and green on 6-month are ones where their acceleration has slowed down, so that's KWT, and therefore probably TAN is probably in here somewhere too. Those that are green on the 3-month and white on the 6-month are ones that are starting to accelerate their gains, so like natural gas and nanotech, more natural gas here. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look-back period. Horizontal red lines are support levels that have held in the past, and which act as resistance on the way up. They also act as price targets on the way down if prices violate through the resistance like they did on Friday. So we'd be looking at the next support level or price target level at 177, which is right at the edge of the floodplain, therefore a very important price level. There are three regression channels indicated on the chart: short, medium, and long term. Short term is the blue, so that's a 10-period regression line. Channel is facing down. The channels are created by the maximum excursion while in the channel, and so Friday's price action stretches the 10-period regression channel, now rolled over and facing down as price fell out of the river and halfway to the edge of the floodplain. The midterm regression channel in line is the black line, lagged one day. The violation out of the regression channel tells us something new and interesting happened on Friday. The fact that it challenged the 90-day green channel here is also instructive. This is a market that's teetering on the knife edge. You can see we only have 4% cushion between us and the sideways channel. The dark blue shaded area is the river, 30-period Bollinger Band plus or minus 1. The light blue shaded area is the floodplain, 30-period Bollinger Band plus or minus 2. The shaded red area underneath is the dragon. That's the 10-period Bollinger Band plus or minus 0.5. We take that as a early warning of shift in trend. You can see that that flattened out and just started to turn downward on Friday. Another day or two of adverse price action that will sharply bend south for the first time in a while. You can see back in in December that what it took to roll the dragon over was about 4 days of selling. This day of selling was so sharp that that's going to roll over here pretty quick. This thin black line is the time series of the slope of the 30-period regression line, which I take to be a general indicator of market health as well. And the blue circles, you can see major turning points, which act as early warnings about changes of trend. Last one occurred here about 6 days ago when the market failed to follow through. As long as that line is above the zero line, then the slope of the 30-period is upward, but it's clearly weakening right now. On Williams percent R, which is a good way to identify overbought and oversold, we're into oversold conditions, not surprising. And then percent price oscillator, which has also been a useful way to identify changes in intermediate term trends and the direction. The jaws open to the downside decisively. They've been pointing down for about 10 days. In ETF2, 5 of the 10 indexes are on cash signals. That puts the theoretical model at 50% invested, 50% cash. The U.S. is stronger than the globals with a score of 78 compared to 76 in EFA. Inside the U.S., the technology is the leader, followed by small caps, then large caps, then mid caps. The two strongest sectors are technology and U.S. small caps. Two weakest sectors, Latin America and Asia less Japan. Inside the U.S., had a couple of the sector spiders turned yellow. Energy, staples, and utilities all weak now, with strength in healthcare and technology. World market model, everything U.S. is above average, with technology exceptionally so. Japan above average. Everything else in Asia is below average, with the exception of Vietnam very strong and China strong. Corporate bonds started to get look a little better now, along with the private equity symbol PSP. Everything Europe is above average, showing some initial weakness in France. Latin America and emerging markets just been crushed. Canada, Mexico, Brazil all below average. Brazil exceptionally so. Inside the business sectors, it's very close between the U.S. and the globals, with the slightest of hat tips to the strength in the U.S. ETF top 30, natural gas just vaulted to the top. Biotechs are still strong. Pharmaceuticals, you can see biotechs still have some emerging strength, with a green on strength and white on consistency. This is a shorter term acceleration factor, and so you can see this whole stack of green followed by white are indicators of that kind of accelerated relative strength. Looking at the Dow 30 through the same lens, Boeing remains at the top. Merck has moved to the top. Then we got Visa, American Express, Disney, and Microsoft rounding out the high strength. None of the Dow companies are in the red. That's healthy for U.S. large caps. Cisco showing some signs of recovery now that it's yellow on strength and red on consistency. ETF liquidity, just for reference. I'm going to shift to the daily report from Friday for Monday. Oops, excuse me. You can see the magnitude of that sell-off looking at the 10-day NDX at minus 68. Plenty of signals in overreaction and channeling. And you can see that's both in ETFs and large caps. Some triple screens in American Express, Visa, and Cisco. Auto framer candidates, not so many of them as you might expect after a sell-off, simply because of the size of the range from Friday. So if we get any kind of stabilization on Monday, you would expect to see an awful lot of trading opportunities on Tuesday. See the recent increase in volatility and the rise of the minus DX and ADX. Ton of symbols to choose from in the auto framer. Lots of channeling and overreactions. Almost everything firing on RSI2. So this is really more of a market condition than it is individual stocks. The broad index selling is what pulled everything down with it and has put everything basically into that situation. You can see on the how many symbols actually made new 10-day lows based on the size of that number, like 75, minus 75 for 3M. That had the biggest relative collapse because it was 3/4 of the range of the last 10 days. That's how much it fell out of the previous 10 days trading range, whereas something like Home Depot only had 1%, and some didn't make new 10-day lows at all. So that might be a place where you could look for some strength. Interestingly, Microsoft and Merck having gains on the day. ETF 30, again, most everything on an RSI2 sell-off. Some reasonable targets here in the auto framer. Plenty of channeling and overreactions to look at. The auto framer sets up a lot of opportunities for us, some almost at 5-to-1 reward to risk. We've been tracking Cliff all this week, which has been a great trade on both the short and the long side. Expanded the charts here on the market mosaic and made this 2 pages so a little bit easier to read. The 30-period regression line is this straight blue line. The polynomial regression line is this curvy black line. Just gives you an early warning on the direction of the most recent direction of the regression, the power of the regression line, if you will. Crossed over its own 10-day moving average back here. uh, and is now slightly below the 6-month average. So we've got a measurably weak market. You can see the longer term time series here. This is the last 6 months of that same reading, and as a reference, just how far we've fallen with respect to the 200-day moving average, down here almost 2 standard deviations below the 6-month average. Part 2 of the market mosaic. This is that 30-period regression line slope. But now looking back past the last 10 years and using the 10-year statistics to set the boundaries. And you can see we're just about back at the 10-month average after having spent a lot of time, more than 1 standard deviation above. That's just how strong this trends of the last months and year have been. And you can see the crossover of the 10 period here. This is the in the last 200 days time series, but it uses the 10-year stats to define the measures. I would take these as stable measures of long-term relative health and where we are. Holding this positive line here at 0.05 is going to kind of be crucial to see if this is just a buy on dip opportunity or if this is the end of the party. What I've found interesting is when you look back past the last, looking at the last 10 years and these big spikes, how the downward spiking movements have been getting shallower and shallower as the market has begun to lose its memory of just how painful those days were. So this is just a hint of fear coming in. Couple measures of volatility here. This is the chart that we use to define that axis on the market health check and market classification system. So we just pulled back into normal. Still below average volatility compared to the last 180 days. Just looking at price or the standard deviation of price divided by price. Fail stat, gain stat for reference, along with signal to noise ratio. You can see just how broadly the sell-off on Friday hit the market. So now the z-scores of the regression lines. This I think does a pretty good job of just framing where we are at a potential turning point, a critical state. Almost a 3 standard deviation sell-off in here in the 10-day regression line, now at the bottom of the normal channel. The 30 has rolled over sharply, almost coming back to the 0 line. And the 90, the long-term trend line, has rolled over. The last time it rolled over from outside the river channel, it was a choppy sideways market. Difficult to make gains. You can see when the 90 went from the 0 line all the way positive, that this is materially different. This 2-month period in here is different than these, where it was gains punctuated by significant pullbacks and tests of the lower boundary of the river. This is the first time that we've actually challenged or tested the bottom of the river. Has really put the last whole 30 days into put all those gains at risk. A real shift in complacency to emerging fear right now. And so this is why that price level at 177 is so crucial. If this doesn't hold, then the next move down is like 165 into here, or 168. Frog statistics just for reference. Holding periods. On the 5-day, you can just compared to historical losses, you can see the z-scores that the Dow was hit exceptionally hard. That sell-off was a z-score of minus 1.5 basically, whereas things like where's a lower one? XLE was hurt relatively less based on that move. Just for reference. And that's everything I want to cover for this weekend's report. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.